Hey, good afternoon, everyone. I really appreciate you joining me. Um, I'm Mark Sachs. I'm from Right Line Trading, and what I'm going to show you today is our Trend 3 or three line system, and it's really unique. And I think you're going to find it different than any other software that you may have come across before, because it has significant amount of predictive value in determining the direction of price off the right edge of the chart. And I want to start with the disclaimer um, that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for, excuse me, for any participation by visitors or subscribers in the futures, forex, or stock markets, or for any profits or losses. Everyone knows that there's a substantial amount of risk associated with trading any of the markets, and that a person can lose a substantial amount of money. Therefore, participation in these markets is not appropriate for everybody. Always carefully consider your financial position, do your own due diligence, and you may want to consult with a financial advisor. And now, if I can just clean my glasses, we can move forward. Now, a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College. I published 15 peer-reviewed articles in first-tier journals. You can Google those articles if you put in Sachs MK. I've been involved in the financial markets for over 20 years. And really what I focused on primarily in my undergraduate work was mathematical modeling. And at the end of the webinar, I'll show you something very, very cool. Mathematical modeling looks at any closed system and determines what forces are brought to bear on that system to determine how that system operates and moves. And every financial market acts like a closed system. So we can determine what forces are brought to bear on price and then place them in an equation. We can determine exactly how price is going to move off the right edge of the chart. Now, our software is one of the fastest growing trading systems on NinjaTrader. I'm going to skip a lot of this. Now, the system trades futures, forex, and stocks on any time frame and on any type of candle. I'm going to show it to you on Unorenco, but when I open the room at the end for questions, if you want to see a stock on a different time frame or a future on a different time frame, I'll be happy to show it to you. If the force is actually relevant, it is market independent, it is time independent. If it only works on futures, then there's something wrong with it. If it only works on stocks, there's something wrong with it. It's got to be a price that universally comes to bear on any financial instrument and determines the future direction of that instrument. Now, all the indicators in this have forward-looking ability. They never lag price, as do 99.9% of the indicators out there. And the software is purposed to predict the future movement of price, because that's the only thing we care about. When we're sitting on the right edge of the chart, we want to know if we're in a long trade, if it's going to continue. We want to know whether we should get into a long trade. This is going to tell you. Now, I trade Unorenco bars, and I don't want to get into a long exposition on why I do. For a very, very long time, I traded range bars. But the reason there's a lot of similarity between range and Unorenco, and that is the only variable that determines when a new bar forms is how far price moves. There's no time component. There's no tick component. So by looking at at movement, I know how far price is moving with no other variable to cloud the symmetry of the candles. And that's the same thing with range. The only thing that determines when a new candle is formed is how far it moves. If it's an 8 range, every 8 ticks or pips or cents, you're going to get a new candle. And for Unorenco, the settings are a little more complex, but essentially it requires a fixed amount of movement on the financial market to create a new candle. Now we optimize all the settings for each of the markets that you're going to trade and each of the time frames you'd like to trade. Now, one of the negatives of Unorenco bars is that they obliterate price action. Now, there's a lot of people out there that put a lot of weight in price action. And actually, I'll be honest with you, I like to trade. I like price action. Like, I like to look at Japanese candlestick patterns. I've studied them till I'm blue in the face, and I think they have some validity. But I'm going to tell you in a second why their validity now is so much weaker than they have been, and why price action is so much weaker now than it was, say, 10 or 15 years ago. You also can't, if you have Unorenco, you can't discern between a rising and falling triangle or a bear or bull flag. So a lot of price action, market structure, Japanese candlestick patterns, they're obliterated. But let me tell you why I don't care that I've lost them. We still do look at some Japanese candlestick patterns because we have unique Unorenco bars. They're called, we've made them ourselves, and they're called hybrid Unorenco. But the essence is this: when Japanese rice traders created candlestick patterns 400 years ago, their basic premise was that the power of every buyer was equal to the power of every seller. And back then, that was true. There were no big banks with their algos. There was no institutional money. So essentially, in general, every buyer and every seller had equal power. And when you got an engulfing candle, that was a strong sign of a continuation pattern. A doji was a strong sign of indecision, possibly a market top or a market bottom. Bull flags and bear flags also had much more validity. But now that institutional money is involved, once an algorithmic trade is triggered and once institutional money is involved, they obliterate all of this. And what we want to do is only trade when institutional money is at work, because when only the commercial traders are at work, that tends to be when the market chops. When there's big money coming into the market, that's when you tend to get a nice trending market. That's when all of these patterns tend to fail, and that's when we want to trade. So this is why, another signal that also doesn't work anymore, at least reliably, that I think worked really well 20 years ago, was divergence. I mean, if you saw divergence develop on an oscillator, it was good evidence that maybe you were looking at a reversal pattern. But now you can stay overbought or oversold for hours, days, weeks, even months. The trade is not going to top out or bottom out until institutional money steps aside. And that's just the way the market is nowadays. So that's why Japanese candlestick patterns and all of the other price action setups have much less validity. They don't have no validity, but they have much less validity. Well, I'm looking at the NASDAQ and the E-mini right now, And boy, they are rocketing to the downside. I'm looking off to the side. I'll show those to you because we're going to go to a live chart very shortly. And boy, oh boy, they are busting to the downside. I mean, we're getting a real market meltdown right now. So what do we do in a market in this kind of situation? What we do is we need to create leading indicators that essentially are proxies for big money. And I'll show you exactly what I mean. Now, the strength of the Unirenko is they filter out a lot of noise. A lot of intrinsic market oscillation. That's just a normal part of the market. So they visually, they represent to you a very clear-cut, smooth market. As long as you have powerful leading indicators, I think they're the best kind of bars to trade. The thing that you also need is for each individual time frame. Say if you want a day trade or swing trade or a long-term swing trade, you need individual inputs. We have those all for you, so you don't have to worry about that. Now I'm just gonna, so here's the 3 line, which is the core of the system. And here's what gives the system all of its predictive value. Now, line 1 is a multi-time frame assessment of momentum. Now, all of our indicators do not assess the movement of price on your trading chart. If they did, they would become dependent variables. And when I say dependent, I mean that price on your trading chart would affect their assessment. And we don't want to look at price on our trading chart. All we want to do is look at price on the 2 higher multiple time frames, because that tells us where price on our trading chart is going to move. So these are all multi-time frame analyses, all looking at the higher time frames. Now, the first one is order flow. And order flow is very, very commonly misinterpreted. And it's taught really incorrectly, really commonly. And let me show you why. If it was as easy as everybody represented it to be, it would be cake to make money. Now, this is a little blurry, but what you see here is 2,985. And what it's doing is taking the bid-ask difference of each individual price level. This could be a pip, a tick, or a cent. It's summing them all up and telling you, are there more buyers sitting on the dome, or are there more sellers sitting on the dome? It's not looking at executed trades. It's just looking at the number of traders with their orders, looking at the number of contracts, the number of shares, whatever that might be, what the difference is. And this is telling you that there's a significant more number of buyers on the dome than sellers. So you get a very large green number, and you get an up candle because there's buying pressure. Now, this represents stacked sellers and this is stacked buyers. And I've seen a lot of software talk about using this. It doesn't have enough statistics. It doesn't have enough power. You need a multi-time frame analysis done in a very special way. Now, here's also a green delta. It's plus 222, but you got a down candle. So you have a predominance of buyers, or buyers are in the majority, yet the candle closes to the downside. This is what makes the assessment of market delta, and what we do is our assessment is called order flow, so difficult. Now, the reason this happens is known. What this number doesn't tell you is the aggressiveness of the buyers or the aggressiveness of the sellers. And in this particular case, the sellers are far more aggressive than the buyers. So let's say the price of this financial instrument is 50. The buyers are only willing to buy it at 50, but the sellers are willing to pay 49.9, 49.8, maybe even 49.7. They're willing to buy it cheaper than it's sitting right now because they are just convinced that this financial instrument's going to fall. So even though there's a preponderance of buyers, the sellers are more aggressive. So if that's an issue, how can you use market delta to tell you the direction that price is going to move out into the future? Now, here is a whole series of market deltas, and this is what most software presents you with. It's a graph of the absolute value of the market deltas. But you know that even though this is rising, you can still get a down candle on a positive delta. So it doesn't have any predictive value. So here's what it turns out, is that one standard deviation's worth of market deltas close in the direction of their color. If they're green and there's a predominance of buyers, you get an up candle. If it's red and there's a predominance of sellers, you get a down candle. And it's the outliers that are one standard deviation's worth of data outside of it that skew this data. So we have to find a way to throw them out. And here's how we do it. What we do is we look at the two higher multiple time frames. If you're trading a 5-minute, we're going to look at the 15-minute and the 45-minute. If you're trading an 8 range, we'll look at the 13 and the 21 range. We look at the two higher fib numbers. If you're trading, say, a 377 tick, we're going to look at the 610 tick and then the next higher fib number. That's what the indicator does. And what it does is it places each of the delta values of each candle on those higher time frames into a 15-period simple moving average. And because what you're looking at is not any individual delta value, but the smooth result of 15 delta values in a row, it throws the outliers out and creates a slope of this SMA that's very representative of whether the bulls are in control of the market or the bears are in control. So when both 15-period SMAs are sloping up on the two higher time frames, you're going to get a green line, and it means that the bulls are firmly in control of the market. When both of these 15-period SMAs are sloping down, it means the bears are firmly in control of the market. And when the 15 periods are not in agreement, that's when you have chop. That order flow assessment line is yellow. And that's when you stand aside. And you're going to see that's when price is going to chop. Now, what makes this really ultra valuable is, one, you're never going to get caught on the wrong side of a trade. This gives you an absolute direction that you have to trade. And if you trade against order flow based off those two SMAs, off the two higher time frames, the likelihood is very high you'll get stopped out. In addition, it leads price. So if you see here, this is just the order flow assessment line. Both of those 15-period SMAs are sloping up. They start to slope up before price turns. So here price turns up and the order flow line is already green. And the only direction you can take this market is long. If you try to take it short, like these traders did here, you're going to get stopped out. And I'll show you other rules and reasons on the live platform, which is going to be really interesting to look at because the NASDAQ is moving like, there must be some news out because it's moving like 100,000 miles an hour, while you can't take these trades short. Your direction is long. Now, if you want to absolutely try to trade a top, which I never recommend doing, I don't think you can ever call a top or ever call a bottom, because it requires you to know when institutional money is going to step aside. At the very least, you can only take it when order flow changes. This provides you with it. Now, there's no entry, but it provides you with an absolute direction. And here's another example where the order flow line turns first and then price turns, and you have an absolute direction to trade. If you try to counter trend trade against this line, unless you're lucky enough to call a top and everything is going to roll in your direction, which is very rare, you're going to get stopped out. Likelihood is exceedingly high. And here's another example. Turns green first, price goes up. Here you've got yellow, and you'll see, I'm going to show you a live chart. You're going to see how this works. Price chops. Then you've got your red. Directional bias is short. Now, I wouldn't trade this short unless I was below the 50. I have certain trading rules, but it gives me a direction. I can't trade it long. Then when it turns green, I have to trade it long. I can't counter trend trade this line. And here's what happens when it's constantly changing color. Price chops. Now it's only one of the three lines. So you don't know whether it's going to stay red or stay green. But I just want to show you that if this continually changes, price is going to just chop around. And then when it goes to green, that's when price will take off. Now, our momentum assessment uses the MACD. There are lots of different ways to assess momentum. You can use an oscillator. You can use Heikin-Ashi momentum. We use MACD momentum. I don't know if one is any better than the other, but I like MACD actually the best because of this crossover that occurs. And essentially, we do the same type of analysis. We look only at the two higher time frames. We don't care about price on our trading chart. And any indicator that looks at price on your trading chart is going to confound the assessment and ruin its analysis. Now, this should say MACD lines, not momentum lines. But when both MACD lines are accelerating away from the signal line on the higher multiple time frames, momentum is green. And when both MACD lines are accelerating towards the signal line, the momentum assessment is red. And when the momentum lines are not in agreement, you're going to get a yellow. So now you have two lines, order flow and momentum, and they both must be in alignment for you to take a trade. And now we're creating more precision with our trading. Now the first line is order flow. First line is momentum, and the second line is order flow. And you can see they lead price, call the turn. They lead price and call the turn up. And now you have two independent predictors of the direction that price is going to move off the right edge of the chart. And if you trade against both these lines, the likelihood of getting stopped out is really, really high. Here's chop. Now it's easier to define chop. You never get green, green or red, red for any appreciable period of time at a pivot. You finally get it here, red, red, on this down pivot, and down you go. You get green, green, right about here, close to the pivot, and you go up. Red, red, you go down, green, green, you go up. Now, I purposely took off the instrument. I purposely took off the time frame because they're irrelevant. It doesn't matter whether this is a stock, a Forex pair, or a future. It doesn't matter whether you're trading a 2-minute, a 5-minute, a 1 hour, a 4 hour, or you're trading a 2 Unorenco, 4 Unorenco, 8 Unorenco, or you're trading a tick chart. It doesn't matter. These forces are universally operational on every financial instrument in every market. Now, they keep you in a trade. When they stay green for a long period of time, you can ride these trades up. You get 50 and 60 tick trades. And what I recommend is when you see that up candle on the down, I'm going to talk about the halos in a minute, you know that you're approaching the exit point and your first down candle, you're out. And you get a huge move and you stay in the move. Again, chop, red, only short. Now the last force is stochastic. Now it does its own momentum assessment, but it does it in its own unique way. And what we're looking at is this. Again, on the 2 higher time frames, not on our trading chart. We have to split them off to make them independent predictors of the future movement of price. Now, the stochastic assessment is a little more complex, and actually the momentum assessment was a little more complex too, and I'll explain it to you a little bit more when I show you a live chart. But when the stochastic line is overbought, it's greater than 80, it doesn't matter whether its relationship to the signal line is irrelevant. As long as the percent K line is above 80, you're always going to get a green. And when the percent K line is under 20, you're always going to get a red. Now, when both stochastic lines are above the signal line and accelerating away from it, then you get a green on both time frames. When both stochastic lines are below the signal line and accelerating towards it, then you get red. And when they're not in agreement, you get yellow. So now we have 3 lines. Now, the first line can be yellow under certain circumstances. That's momentum. And we'll talk about that in a minute. But here's the bottom line with the assessment. Because you're looking at 3 lines and they change color intra-candle, this is not a candle close assessment, it can get a little complicated. So what we do is we project the results onto the candle body halo. Now you can control the thickness and the color. I like to use yellow for a down, and I use blue for an up. So you don't have to look at the 3 line anymore. All you have to do is look at your candle body halo. And you see this up candle body is on a down 3 line. Order flow, stochastic, and momentum have already turned to the downside. So your first down pivot is going to crash the market. That's what you're looking for. Oops. So if all 3 lines in place become a little bit confusing, like I said, we project the results directly onto the candle. And here's another example. Here's your pivot. There's your down candle blue. When you get that down candle on an up 3 line, you're likely to get the next candle up. You're in at the pivot. And even though intermittently you're going to get a yellow, you take this trade all the way and you would be out maybe on your first down candle. Then you can enter right back in on this. You're out. Can't enter here. This is black. And that's our equivalent of where there's no alignment. You get the alignment 1 candle over, you've got to trade. If it's 5 candles over, you have to stand aside, and up you go again. Here's your down, haloed in yellow, down. Here is where you just don't have a trade. Now, again, here I just wanted to show you its forward-looking ability. The up candles, haloed in yellow, it foreshadows the next down candle on the 3-line aligned to the downside. There's your up candle in yellow, foreshadowing the next candle to the downside. Here's your up candle in yellow, foreshadowing the next candle to the downside. Now, if you want to make your workspace as clean as possible, you don't even have to project the 3-line. You can make it transparent. Now, on the chart I'm going to show you, it's not going to be transparent. So I want you to know that it's there. But you don't need it if the sum total of the assessment that it makes is projected onto the candle bodies. Why even have it? So what we do is we get rid of it. And all we care about are the candle halos. And sometimes you get that forward signal and up. Here, up. Here's your down, off the halo. Now this is really no entry. Even though you have the 3-line, I'll show you later why you don't take this short. Here's what you're looking for, but you have no entry here. The next candle doesn't have the halo, and the next one doesn't have the halo. You're not moving 4 candles over. The trade is too mature. You have no entry. Here, black, you have no entry. Second here, no entry. You can't slide 3 candles over. Maybe 1 over, but not 3. Here's your short entry. This is where you get your big runners in the direction of the trend, which is down, with the 3-line in your direction. And I'll show you that on a live chart. Now, the exponential oscillator is what gives us our entry signals. Now, it's not absolutely required for an entry, but a signal does decrease the risk of an entry. And there are 3 types of entries. I'm going to show you all 3 of them. But what it does, let me go to this slide first to show you how the signals are generated. Now, because we wanted the oscillator to move fast, we took the oscillator formula, the stochastic, and we raised it to the 2nd power. And we created an exponential formula. So this moves a lot faster than any standard oscillator. And every time it crosses to the upside through this cyan line, which is the 50 line, it generates this up triangle. And if this was haloed in blue, you'd have a long trade. When it crosses the cyan line to the downside, this was haloed in yellow, you'd have a short trade. Now these are signaling oversold, and I had them removed because we don't use them. I mean, some of our traders like to leave them in, but if I don't use it, I don't care. When the line drops below the 20 line, it's going to start signaling you these, but you want the down red candle and the up red and the up blue. These up reds are just not a part of the platform anymore. Now this is an up entry, but it's way off the pivot, so you can't trade it. And here's your perfect short right here through the 50 line for a down trade. Now, let me show you the live platform. Take this off. And here we are. Now, we're throwing 2 bonuses in for the first 10 traders who come aboard. One of them, they're both extremely powerful, and they're indicators we normally don't include. One of them is background bias. Now, I have to tell you, As an independent predictor of price, it is stupendous. And I'm looking at crude. We can look at any instrument later that you want, that you like. But what this pink represents, 99% of the time, when you see this background on someone's chart, it's because it's assessing how price moves. They're using a MACD. When it crosses over, your background goes pink. So who cares? It's telling you the price is falling, and we already know that. What this pink is telling you is that there's a multi-time frame alignment of crude to the downside. Remember, we're always doing multi-time frame assessments. It does not look at price on your trading chart. It just looks at your two higher time frames. If the two higher time frames have the 50 down and the 15 down, and price is below them both, price on your trading chart is almost always going to fall. So this dark pink is the sweet spot to trade short, and this dark green is the sweet spot to trade long. And what we're looking for are low risk entries. Now, there are three different powers on here. If you come aboard, I'm going to do a master class with you and explain what those are. For this webinar, I'm just going to stick with the dark green and the dark pink. And you can see how this dark green has tremendous predictive value in the direction that price is going to move off the right edge of the chart. It's really, I personally believe it's the most powerful indicator we have. When the two higher time frames have the 50 and 15 up and price is above both, price on your trading chart is always follow. Now, the other indicator that we're including, that we also usually don't include, is the pivot indicator. Now, most pivots are created wrong. Japanese candlestick dogma tells you that a pivot comes off a candle body, not off a wick. It's easy for software developers to create pivots off the wick. It's tougher for them to create them off the candle body. But the candle body is where they have relevancy. And if you look at some places, you're going to get hit after hit. I mean, even right here, you get a pivot. Price comes up to it and bounces. Price comes up to it and bounces. Then finally, you get a break. But you're going to lose. Now, we have no entries here. But the point I'm trying to make is, if you try to trade into an unbroken pivot, you're going to have your hands full, and you're going to take lots of losers. Now look at what happens here. Price comes down, bounces. It comes down, it bounces. It comes down, and it turns the market. That's how powerful the pivots are, because they're created at the right spot, not at the wrong spot. Now, the other thing is, Japanese candlestick dogma tells us that pivots only break when 2/3 of the candle body closes above it or below it. Not just a little, no candle, no wick, and not just a piece of the candle body. So you see, even though on this move here, you've got a little bit of candle body above, and this wick came above, the pivot continues to trace. And it continues to trace because no 2/3 candle body broke it. Finally, it gets broken right here. So you've got a pivot indicator that actually works the way the Japanese rice traders wanted it to, and that it still has tremendous validity. And you also have this multi-time frame background bias, which further censors your trades. This is where you're going to take your long signals. And this is where you're going to take your short signals. Now, the other rule that we have is you only trade short below the 50 and long above the 50. And when you add those all together, you're going to get great signals to trade. And you're going to get very, very few losers. And we'll just go over crude for a while and we'll see what we get. Now, I don't trade when there's no background. I want that multi-time frame analysis. And remember, above the 50, I don't look at short signals. I'm only going to trade long. Now, this is a terrific long signal right here. And you can see you have the blue candle outline. But I'm not going to trade it because I don't like to trade without background bias. I want to put everything in my favor that I can. I don't have a multi-time frame alignment here. I am not trading it. Here's where I'm going to take my trade, right here. Now it's tight to a pivot, so it's very risky to trade into an unbroken pivot. What you may want to do, well, so you can't take that trade. Here's the lowest risk trade, the pivot break and the run. If you don't want any risk, that's your entry. If you want to assume significant risk, that's your entry. But they both work. So trade number one is on an arrow, is on an oscillator signal. Trade number two is a break of a pivot. And the reason a break of a pivot is so powerful is because sitting in this pivot are tons of buyers who want the market to go up. When you break the pivot with the 2/3 candle body closed below it, you stop everyone out in the pivot and it helps shove this trade down. And we get trades that break pivots and they just slam up. They snap up because all the traders in that pivot pushing the market in the counter trend direction get stopped out. Now here's another trade. You have to wait for the pivot to break. It breaks here. Whoops. And you can always move one candle over from the entry signal. You don't have a 3 line here, nor we actually do have a pivot break. Here's where you get a clean pivot break and the 3 line, and you can go one candle over. That's acceptable. I'm only trading pink. So I'm going to eliminate every other trade. I'm going to sidestep losers and I'm going to give up some winners, but I only want to take the lowest risk trades on the chart. And that's all that matters. Let me tell you, the goal of a day trader is not to get winners. The goal of a day trader is to avoid losers. And it's the same as it is the same as a swing trader. If you can avoid the losers, you will get automatically great winners. But that's got to be your mindset. Is there any increased associated risk in the trade I take? And if there's any, do not take the trade. Wait for the bread and butter trade. I mean, here's a short trade with an oscillator signal. You don't have the 3 line. You don't have background. And yeah, it works, but I'm not taking it. And I'm only looking for long trades when I've got the green. And I'm going to get them. Look at this trade. There's an oscillator signal. And there's my low risk winner. No muss, no fuss, up it goes. I'm not going to take the continuation. I've got the upside pivot, and if I get a big winner, I'm going to consider the market to be technically overbought. You can't chase any instrument up forever, and I don't like to take trades that are too far off the 50, which is the mean. And actually, you have another trade right here on green background. Now, you can at the pivot, you can either take the trade out or sit on your hands, hope, tighten your stop, and if it breaks, you've got yourself a longer run. It's up to you. There's no right or wrong there. Here, there's nothing. We have no pink, and we have no green, and no setups. Remember, I'm only looking for the lowest risk trades I can take. Now, here's a pivot break. Remember, I told you, you can trade any pivot break as long as you have pink background and you have the 3 line. There's your winner. There's your pivot break. And there's your winner. Remember, there's tons of buyers here, and when they get stopped out, they're shoving this trade down. These short signals are into this unbroken pivot, no 3 line. Could have been 2 losers. You wouldn't even consider taking those trades. Look at the candle halo, it's black. No trade. That's equivalent to no alignment. All through here, total chop. You're not doing anything here. You just, one of the other problems with day traders is they overtrade. And you're just not you're gonna sit and do nothing. You're not taking this long trade. That long trade's a loser. This long trade's a loser. This long trade's a loser because you don't have exactly what you need on a trade. And we don't have the pink or the green. So we're not going to trade. And there's our pink. Now this has the 3 line in the wrong direction. You can always go 1 candle over. That's allowed. And you can take the trade. Now this may be the first loser we found right here. And we've just gone through a million winners. And I don't want you to think you're never going to get a loser, because you are. About 85% of these trades are going to be winners. 15% will be losers. So your win percentage is going to be very high, but you're never going to be 100%. If I told you it was never going to take a loser, you should just leave. Now, the other trade that we take, now this is 1 candle over from a pivot break, but you see this big pullback? This pullback, where I'm going to go over this ad nauseum in our masterclass. This represents a bull failure. The bulls tried to pull the market all the way up. They couldn't do it. Bears pushed it all the way down on pink with the 3 line, and we're in. So we have 3 entries. 1 is on a pivot break with the 3 line. 2 is on a pullback wick with the 3 line, and the 3rd is an oscillator entry with the 3 line and background bias, and the 50 and the 15 red or the 50 and the 15 green. It filters out almost all your losers and it gets you a very high win percentage. So I'm gonna show you the offer, and then I'll let you pick some instruments, and you can pick some time frames. It doesn't matter. Here it is again, and that is absolutely a first target. At least for me, it is. On crude oil, I'm looking for 7 tick first target, and that is easy 7. And I'm looking for a big runner, but that's gonna lock in profit and bring my stock to break even. Here's another winner. That's a pivot break. 2/3 above. Up you go. Just stay with the rules. Stay patient. Don't rush your trades. Don't assume any risk. Here's another winner. Here's the pivot break. I didn't cherry pick this market, believe me. We can trade a break as long as we have the 3 line. What you do here is up to you. You can take the trade out, or if most of your contracts or shares or lots are gone and maybe you have one left over as a runner, tighten your stop and hope that it'll bust through and you can get more money. I mean, that's totally discretionary. You've already locked in money when you take the trade. You know, this is the pivot breaker. So you have the pivot breaker, the pullback, and the oscillator signal. Those are our 3 generated entries. So let me go to the offer and then I'll answer any questions. And you see, here's a huge move, long, but we can't take it. And I never cry over missed winners because my goal is to avoid the losers, not to grab every winner. Here's pink. I'm not trading pink, just trading dark pink. This is light. It's a weaker background. And in the master class, if you come aboard, I will tell you the meaning of all 3 down colors and all 3 up colors. For the most part, we're just trading dark pink and dark green. That's all I traded today. And look at this pivot breaker right here. I mean, these are, I mean, if you take one trade, this one trade with 2 contracts, and you're out on a reversal candle, that's 53 ticks. I mean, that's a $2,000 trade. So, or it's a $1,000 trade, whatever it is. That's a $1,000 trade. So I wanted you to see the system on a live market. I'll rotate it to any markets you want, any time frames you want, and look at anything you like. And here's the offer. I think it's a really good one, but maybe I might be biased, but we're giving you a lot. Let me just go to slide showing from beginning so I can just make it a little bit bigger. And then I'll answer any questions that you have. And here's the 3 line that we went over. Now it's $497. For that, you get free license, you get a lifetime license, you get free upgrades for life. So if we make it better, and we're always improving our software, you get that upgrade for no charge. You're going to come into the trading room with me for 1 month, and we're going to trade together. We have 150 traders in the trading room. It's a very great community of traders. Everyone's friendly, everyone's nice, everyone's helpful, and trading's really lonely. You know, you sit there in your computer in your house, and sometimes that leads to over trading. You're not, you know, you're gonna be in the room. I'm not, you know, I don't joke around in there, and I'm not a big, you know, joke teller. But I call the trades way in advance. Chart Trader is up. Every trade is scaled exactly, and at the end of every session, I show you the back end of my Ninja Trader. I mean, the transparency in the room is incredible. I just don't say take a short, put a line there. I actually execute the trade. The stop and targets are projected, and the profit loss in every trade is right in front of your nose. And then at the end of the day, we go over every trade. I mean, look at our profit loss for the day, for the week, and for the month. And then we include the commissions. You get a 10-module weekly educational training session, which is really good. You get a video tutorial library, it's 450 videos. And you also are going to get that, I didn't type it in, but you're going to get that master class with me. And I'm going to go over this platform with you until you can trade it in your sleep. And the first 10 get that background bias and the pivots. I think the background bias is enormously helpful. It filters out a tremendous number of losers and gets you into the really juicy runners. Because when you have that multi-time frame alignment, it can only be caused by one thing: institutional money. as a closed system, it has this predilection to move in random, in random chaos, just like every closed system in physics. The only thing that brings a multi-time frame alignment is big money. And that's when we get the trade, and that's when we get the big runner and the pivots, which we're throwing in. And the offer expires on Sunday night. So let me go to questions. I'll leave the offer up. I'll just show you our phone number, and then I'll answer any questions. And if you want me to project the charts and show you some other time frames, I'd be more than happy to do that. Except the phone number's wrong. We've changed it since then. So let me take that off. And hang on one second. If it can go wrong for me, it does. But the phone number's on our website, and really what I want to do is answer your questions. So let me go to them. Okay. Okay, well, yes, it works on NinjaTrader 7 and NinjaTrader 8, and it can also be powered by TradeStation and a couple of other platforms. So just call us and we'll let you know. You can also trade it in demo, and you can do that for free. So it really is tradable, irrespective of your favorite platform. You can take the signals off of a demo platform and take them on your live platform. And okay, I'll show you a stock. Why don't we look at something that's volatile? Let me go to the NASDAQ 100. Now I think let me just show you. Let me just quickly show you the NQ, because the NQ today was crazy. That takes a little bit of time for everything to load and calculate, because remember, it's doing a multi-time frame assessment. So it's going to take a little bit of time for it to populate. Okay, here we go. Now the NASDAQ's moving like a rocket ship. On to the pivot. Look at this pivot breaker on the NQ. Gigantic move down. Pivot breaker, another really nice move down. No background. Now here is really significant chop, and this does catch you here and here. I mean, the market's really chopping. Nothing. Into resistance. Nothing. Into resistance, into resistance. And here's your beauty. Look at this trade. Huge trade. So it doesn't matter what instrument you're looking at, what time frame, and let me show you one stock. Why don't we look at here? We'll look at on the NASDAQ 100. Why don't we look at Apple? Apple tends to be not that volatile, but we'll take a look at it. All right, it's loading. It's going to take a minute. Hang on one sec. Let me just make sure I have my stock data feed connected. I should. Here we go. There's Apple. Here's one trade. Well, why don't we go to the start of the day, and we'll just review one day on Apple. There's a lot of movement on Apple. Holy God. You know, I'm going to change this to a 4-unit Renko, which is slower because we've got too many candles. We're going to go to a 4, 10, 20. Slower. All right. Still a lot of candles, but at least it's not quite so bad. All right, here's your first trade right here on the pivot break. Well, it's not quite green. Let's keep looking. And there's a short trade right there. Not a big one. There's a continuation on a wick on pink. Nothing here into support. Here's your trade. All the way up. Now, if you want to day trade a stock and leverage options on it, this is the way to do it. You have no trade here. Here's your pivot breaker. All the way down. No pink. Here's your pivot breaker. It's a small trade. Here's your pivot breaker. You can't take it. Here's the pivot breaker that you can take. So I mean, I could do this all day. I think you get the idea. So listen, thanks so much for coming to the webinar. I really appreciate it. I hope if anything, you learned a lot. The forward-looking ability of the system is really, really good. And you are going to get about 85% of your trades are going to be winners. It's going to filter out an enormous number of losers. And the background bias and pivots give it tremendous additional power. So have a wonderful afternoon and a wonderful weekend. And I hope to see you in the trading room. We make money almost every day, not every day. We made money today, and let's be really successful traders. And I'm going to work with all of you to teach you how to use this platform exactly the way it was intended. And if there's any ambiguities and you're just not sure, we're going to have a masterclass for it. So everyone have a great afternoon, and thank you so much. Take care.